Hey traders, this is Blake Morrow with Trader Summit, and I have with me once again, I have Mr. Chance Finucane. He's the Chief Investment Officer of Oxbow Advisors. Good to see you, Chance.
Good to see you, Blake. Great to be back.
It's nice to have you back, especially kicking off 2023. You know, last year, I remember our conversation pretty vividly. You guys were pretty defensive, which was a good place to be last year. But going into this year, markets kind of turned higher towards the end of the year. People are pretty optimistic that maybe we've got a soft landing ahead of us. How do you feel going into 2023?
Our stance has not changed, even though we had a significant down year for stocks and bonds in 2022. We think that was almost more a phase that was more around the increase in interest rates leading to valuation multiples coming down across a lot of asset classes. But 2023 to us looks like a recession year. And when you have a recession, that means that profits typically decline compared to the previous year. And you also see some investor capitulation where multiples go even lower than they already have, where right now they're probably at about an average level if you look at a price to earnings ratio for the S&P 500. But usually that would come down a bit further along with profit estimates coming down. So we look at this and we still are defensive. The atmosphere for bonds has gotten a bit better. We like the short-term treasuries, for instance, that are now yielding over 4% compared to yielding 0 18 months ago. But we really think it pays to be defensive and letting this continue to play out while the Fed continues to raise interest rates and is going to try to keep rates higher for as long as they can.
Now that's you bring up something really interesting because over the last 20 some odd years, you could say roughly, maybe give or take, being in a recessionary environment doesn't necessarily translate to weakness in equities per se. But we're in a different environment than we have been in the last 10 or 20 or 30, even 30 years in this higher inflationary environment. Do you think the Fed, seeing a recession, let's just say you're correct, and we are in a recessionary year, and we could just argue, for sake of argument, we could say it's a relatively, average recession. Most investors would expect the Fed to flinch, ease up on monetary policy. Do you feel that that's going to be the case? Because that would support equities, but what are your thoughts with that?
We really think that the Fed does not want to pivot. Their main goal here is, one, to try and bring down inflation, but maybe even more so, they're trying to get rid of this excess speculation that has become more intact in the financial markets over the last several years. We think Chairman Powell is really trying to get rid of that. And as a result, they want to keep rates high for as long as possible without breaking the credit market. So right now, you've still got the S&P 500 trading around 3,900. You haven't seen anything really break in the credit market here in the US. And so from their standpoint, I imagine they just want to keep it at this level and even keep increasing rates a bit so that they can continue to drive down inflation and drive out some of this excess speculation.
That's an interesting point of view. When you're talking about rates, one of the markets that's really affected is the housing market. I've had a recent discussion with your colleague, the owner of Oxbow Advisors, Ted Oakley, and he was pretty bearish on housing. And housing prices they've kind of stalled, but the housing market volumes have crashed. You could almost call it that. Everything's come to a standstill. What happens in the housing market, especially here in the U.S., because you have so many people that have mortgages at a relatively good rate, let's just say sub 3%. Yet we've also seen, maybe a shift because of COVID, a lot of work from home families. So maybe the desire to be out of multifamily homes and into bigger residential homes. How do you see housing going into 2023?
Yeah, I watched that interview that Ted did with you a few months ago, and I remember Ted saying he thought home prices nationally could fall by about 20%. We still think that it's going to be that kind of difficult environment for housing. This would be year 2 of that, really. And you pointed out the sales volumes have really fallen. They're down 40% from their peak if you look at monthly sales volumes from where they were at the peak about a year ago. And when you have sales volumes fall that much, prices tend to follow. And the reason for that is first, the activity stalls, and that then increases the amount of supply. And even though there are fewer families needing to sell or move out of their houses or being forced to move out of their houses, like happened coming out of the 2008 financial crisis, you still are going to have enough things that happen in people's lives that they will need to move. And so I think that will generate enough activity that it's going to cause prices to have to come down to find a new equilibrium where some deals can get done. And the fact that mortgage rates are still as high as they are, it's just going to be difficult for people to pay these high prices that we saw the peak reach. And it's going to especially be a problem in some of these areas of the US that really saw prices skyrocket. So some cities on the West Coast, like San Francisco, Los Angeles, Seattle, and then some other areas that became popular like Las Vegas, Phoenix, Austin. And then maybe in the Midwest or the Northeast, it's not going to be quite as big of an issue because you didn't have that same sort of jump in prices in 2020 and 2021.
All right, that's something that I think is as investors we think about how do you think that's going to impact consumer spending moving forward if house prices are coming down? Is it going to have a huge impact because on those homes' balance sheets?
Yeah, we think it will have a continued impact. So if you wanted to break out sort of income demographics, this is a topic that comes up right now because there's a term that's being used called excess savings. All of that fiscal stimulus that was sent out in 2020 and 2021, a lot of households have been running down those savings. And depending on which part of the United States you're looking at, if you're looking at the lowest income demographic, maybe the lowest 25% of households in income, they're on the verge of running out of savings within the first quarter this year from those checks that they got from the government the past 2 years. And so they're going to have a bit more trouble. The flip side is the highest income demographics, they pay more attention to their net worth or their wealth. And that's the point you're getting to is as you start seeing home prices decline, along with the drop in value in their stock accounts and their bond investments, that's going to then have an effect on their spending as consumers. And so I think we were sort of looking at that starting to weaken through the holidays. And we think now that we're through the holidays, we would expect that to continue to deteriorate in the first half of this year.
So now that you've given us, and I remember we're the Traders Summit, so we have a lot of traders that watch what you're doing. They trade the markets pretty actively. They love to listen to themes from investment advisors or risk managers like yourself, and really like to take your themes and run with them. Where do you think the place is to be in 2023 with your current outlook? Where are the places that I want to be as a trader trying to take advantage of the market?
Sure. And I know our time horizon is a bit longer than a lot of the group that follow you on Traders Summit. But I think for us right now, the best places to be if we get a new client or new account, we're focusing on short-term treasuries. And we've heard the pitch and believe the pitch on the 2-year treasury being a good place to be just because we don't think the Fed is going to be able to keep rates high forever. And some point in the next couple of years, they'll probably have to pivot if we get a true recession setting in the US or globally. So you can see short-term rates come back down, but in the meantime, you're still getting a 4 to 5% yield. So that's one place to start. Another area where we've been adding a bit to client portfolios is in gold and precious metals. That's actually an area that has held in very well. If someone had told you in 2022 that the US dollar was going to appreciate as much as it did relative to other currencies, that's usually a bad environment for the price of gold. And yet gold held in okay. The gold miners and gold royalty businesses are starting to do better in recent months. And so that might be another place as an offset for an area to go long in your portfolios against some other areas that you might expect to deteriorate further if that recession kicks in this year.
Okay, that to me makes a lot of sense. I think there's a lot of people that are very bullish on gold. Do you see it hitting a new all-time high? I mean, 1900 is just a skip and a jump away from where we're at. So what are your thoughts there?
Yeah, we would expect it to continue to appreciate in the years to come. Really, if you look at gold, there's two main factors you're paying attention to. One is real interest rates. So taking the 10-year Treasury yield and subtracting out expectations for inflation over 10 years, which right now I'd say maybe it's about 2.5%. And then you're also looking at the fluctuation in the US dollar relative to other currencies. And so if you go through a stretch here where the US dollar weakens and you get long-term interest rates coming down, so the real interest rate comes back down, that's a good environment for gold to continue to appreciate and to maybe own some of those miners or royalty businesses as well.
Well, Chance, I love chatting with you. I love the fact that you're the CIO of Oxbow Advisors. Can you tell us as traders what's the best way to follow your work and what you guys do over there at Oxbow?
Sure. You can go to our website at oxbowadvisors.com to just learn more about our principles and the way we approach investing in the markets for our clients. And our media team has also built a pretty robust YouTube channel. If you search for us at Oxbow Advisors on YouTube, you'll be able to see all of our videos. And at the end of each quarter, Ted and I put out 2 separate videos. He does a quarterly market update that hits across asset classes. And I also do an equity market update. And we try to send those out right at the end of each quarter, at the very start of the new quarter, so that people can see what we're thinking with a full quarter ahead. And that might be useful for your group as well.
100% it would be. Folks, if you like what Chance said to you today and spending time with you, make sure you give him a thumbs up, subscribe to the channel so you don't miss any of this exclusive content. Mr. Finucane, great to see you. I hope to see you again, at least in the first or second quarter of 2023.
That was great, Blake. Thanks again.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.